Hi, and welcome to an explanation of petty cash. What is a petty cash fund? A petty cash fund is an amount of cash kept in an account or in a fund that is used to pay for minor expenditures. Minor cash amounts are burdensome if required to be logged in the usual authorized electronic transfer or double-signed check form. Therefore, one of the two cash controls, petty cash, exists. What are the operating activities of a petty cash fund? First, you have to establish the fund, then you can make payments and transactions using this cash, and finally you must replenish the fund, allowing you to make future payments from the fund. And how do you go about establishing the fund? Firstly, you must write a check for the amount of cash that you're going to place in the fund. Then you must cash this check. The next step is placing this cash under the care of an employee, and finally you must write a journal entry to record the establishment of the fund. In order to demonstrate this, let's look at Sarah's fashion business. She wishes to establish a $500 petty cash fund. To do this, she first records the date as 1 June, then she debits petty cash and credits cash. After the fund is used to pay for expenses, one must replenish the fund. The remaining cash in the fund is counted and the company cashes a check for an amount that brings the total in the fund back to the original balance. The petty cash replenishment report looks like this. In Sarah's case, she has used the fund to pay for postage and stationery, and her total receipts are $200. She therefore has to note that there is $300 remaining in the fund and that she needs $200 to replenish the fund. This then needs to be recorded. In this case, postage expense and stationery expense are debited for the individual amounts, and cash is credited for the total expenses for the petty cash fund. When a petty cash fund is replenished, the amount of cash needed for replenishment should equal the total of receipts. This is not always the case due to many varying circumstances, such as receipts not being received or wrong change given. In these cases, the discrepancy is charged to an account called the cash over and short account. This temporary account can be either a debit or a credit account depending on whether or not there is spare cash or cash missing. A debit balance increases expenses, while a credit balance decreases expenses. Using Sarah's business as an example again, note here there is a discrepancy in the amount remaining in the fund and the total receipts. This $50 needs to be recorded and taken into account. We are now recording the discrepancy into the cash over and short account. See here how we have added a record for the cash over and short account, noting the $50 discrepancy.
Created using Powtoon.